Good morning. NFLX daily. How about that? Look at that top reversal at 300. This date, by the way, was back in the week of 7/13. And we were right in the middle of the correction in all the indexes and things like that. And NFLX had some news coming about. They had a volatility gap. And they had another volatility gap. They had two volatility gaps. This one was a buy-side daily volatility gap. This one here was a morning gap on a headline event, and the reversal started here. So as we have been reversing for several days, even though that we've had upside volatility within the original reversal, and that's this big 1, 2, 3 delta down bars, and a delta is $4.65 per line. The upside volatilities were to sell all rallies on NFLX, and we finally made all the lower lows in the world. Because the amount of reversal and the amount of daily trend management that goes in here, you would know how to trade long against your original short. So you'd be short up here, and at days when I want to go up, you trade against it, cash it in, and let it keep doing its thing. And it's learning how to trade the opposite side of what your position is within a longer downtrend structure. And why trends have levels of stages that work their way down, but they always have these little upside volatilities before they roll over and make their last lows. And over here, they pop up, but they roll over and they make a lower low. And over here, they pop up, but then see the low here? This low is lower. They pop up, oh boy, that was a gap down, left elbow, and a pop right back up. These are all daily price action bars within a multiple of 5 days in a multiple of building weakness and strength. Price action volatility is both directional movements, but you keep making lower lows. And whether it's on a daily or a 3-minute, 15-minute, or 60. But then, having said how we've been putting this bottom in over here, because last Sunday we said that we would go higher in the last dog day. So we got down here and we started testing these lows of 203 here. This low over here was 204.09. And this low was that big daily breakout bar, and then consolidating the half bar. So now that we know where we're at within the trend structure on a daily level, we're going to kind of slide this over out of the way, and we're going to take a look at where we're at. So we have a $250 call right here on NFLX. It's a 9/17 expiration. Okay? And one of the things that we look at with our MMTs in our option trading division, that is that there is a certain data set and requirements that you buy wholesale. Do you ever have to go to $250? No. How far do you have to go to move it? Well, let's take a look up here that the next levels that we would be looking at is we would be looking at this half bar, and let's get the value of it. It looks like that was on 8/17 of 2011 at 234.81, and that the last print on price or NFLX was 221.89. And so basically that half bar, when you take a look at it relative to here now, so here's your column. Let's pull this up for you. Let's make sure it's in the video. This is the number you're going to go by, MMT. That's your number right here. Now, let's make sure it populates that. That's 8/17, 2011 at 234.81. And let it be known, MMT, that at that time, on that date, you were minus 8.38 ratio below that half bar. So you have your historical data. You would know that the upside volatility from a breakout here is going to be right across this bar right here On 8/9 of 2011, that half bar was 232.12. But now remember, at that time, you were closing $9.22 above that volatility breakout daily before you rolled over and made a lower low now. And the thing about it is that this particular bottom starts here 1, 2, 3, 4, 5. It's these 5 trading days here that is the most relevant. This was a new day within the last lows and the bottom up process. You start counting 5 going to the right side. That is the actual element of the price. So you start day 1 over here against the last 5, and you blow up this part of the trend. You can clearly see what your half bar resistance diamond level alerts are, and what you want to see on the upside here is you want to see this bar closing above that diamond, and you're going to have to see a bid pop going in this direction. So that means you're going to need to see a bid pop diamond, just like when you're going in downtrends. Notice how the diamonds on a daily level are going down until they finally hit a bottom. Then they pop up and they start to change. And that's where bottoms get weighted, and learning how to be the market maker between the public and getting your entries and your exits are everything. So when you're using your MMT platform, you know that that bar is 232.12. This half bar over here that was created on 8/8, the half bar is 228.58, and that date 8/8/211. You will notice that you were $17.01 below that last half bar negative ratio when you made that volatility bottom up trade before you made a lower low. And when you were at a negative ratio and it stopped going down in here, you popped up with the diamonds. See how they're popping in the direction? The thing about it is that you were minus $17.01. The higher negative you are, the bigger the short-term volatility reversal bottoms come into play. And they're always validated that this number here, from that big drop, it was only it was closing 9.22. There was a big turnaround. So what I'm going to tell people is, in the shorter term, 228.58 is another half bar, and you would put them from lowest to highest, and the date in the info panel structure. So when you're doing your half bar workshops, this is how you'll look to get them. And so when we're looking at the upside, we can see that the 10-day moving average is a wall of resistance as far as that goes. But we do know that if we start to break higher in the last days of August trading, that when we look at where we're at here, we can see that over here is the call contract. And I can't have them both up at the same time, but here, we're going to get into the call contract. We already looked at the chart. Now, when these contracts on 7/13 were up here on the highs of $59.60, that's these right here, you can clearly see that the high was $59.60, and that the lows down here are getting a market made, and that the lows down here were 0.87 pennies. And we've, so far from that 87 penny level, we closed on the last print on Friday at $1.70. Yeah, it's a 250 call. It's a 250 call chart. Okay, that's what this one is. This is the one we're working with now. Okay, this one right here. Yes, it is. And yes, it is true what we have over here. And the relationship of NFLX bottoming processes are what they should be. we can clearly see where the bottom of the option price got put in. And it's got, you know, a range that where that premium can be traded based on NFLX breaking higher. Right here. That would be one nice movement in this part of what we did in the cycle trend, and this part of a upside volatility price. This is the kind of trades that you're looking for on a daily ascending price level, testing half bars, but then the upside volatility is strong in these kinds of candles as the primary example. And when you are putting in bottoms, you look at the time of the bottom, and then you can see clearly, this is another view of the bottom. This is a view of the bottom of these call contracts. This is the SMF platform. So if we're going to break higher up and test these half bars, that means that the intraday entry level here in the 250 call is buyable. And by breaking higher, if the breakout, you know, is validated, we will see that we would break higher in those price levels that I gave out on this video. And the current bar is 220.49 on a daily level. And you want to consolidate that low here, or where I said it was. This is the actual half bar that traded on Friday, 8/26. It's highlighted, 217.50. And you want to know that you closed 2.82 ratio higher than the half of it. So basically that's this raw element right here of that directional price movement on Friday. And that's a breakout bar on a daily bottom up level. And the dog days of August are here. If there's light volume in there, we're going to look at how to buy the pullback here. And when breaking higher on the next daily breakout bar, our wholesale entry here will go higher in value, and this call chart will go up in value. And let me explain something, everyone. It's about inflated values were to be sold and deflated values. So there's a big discrepancy mathematically between that value and this value from here to there. And what it means is that that was an inflated price up here and they were going to come down. And you take a look at where the inflated contracts have taken themselves all the way down to these levels, 87 cents. You take a look at where the stock was at 250 call when it was down there. We were making lows in the equity side of around slightly above 200. Here, let's find out what some of the lows were right here. Okay, that low was 203.35. That's what the low of that was. And the low of this bar is 217.50. So we know that we're going in the right direction. Upside gap, meaning that an upside, if they gap it up in price, it's going to come back down in value. However, if it bounces, if it sells to the bottom first, you're going to get the biggest part of that trade from that delta line all the way up 2 delta lines to 2.5 delta lines or 3 delta lines. And each one of these delta lines are $4.65 times 3. Okay? So those are daily lines now. 4 point, what did I ever say it was? 65 times 3. That equals $13.95 in the potential next breakout trend, which would in return get the wholesale value of the deflated contract down here, the 250 call, which is up and out of the money. It was as much as $47 up and out of the money when these contracts hit this low right here. They hit a low. That low was 87 pennies. The high was $1.70 in that day, and that was on 8/23 of 2011. They opened at $1, went up to $1.70, and came down to 87 pennies. Look at that, and they closed at $1.62. That was on 8/23. That's what's going to happen with that bottom-up trade. We will confirm this trade on Netflix, because if Netflix doesn't work out the right way, we already know one thing for certain. And what is that going to be? We know that the put side of the market would come into play. That's the short side. If it doesn't break higher in the daily, in these calculations, and that bottom up trade goes and you break up 13.95 higher in a couple of days, these contracts go higher. But on the other side of the coin, if they do not, well, then Netflix has a lot of trades, and we already have them in the Market Minder. We already have a $200 put where it was, and a $210 put, and a $210 call, a $220 call at the strike price, and a $220 put and a $250 call up and out of the money. And what we will do is that we will take a $220 call that expires this light August trading day of August coming up on tomorrow morning, and we'll throw in the weekly expiration down here. We'll even throw in the weekly expiration and the call ratio of the 200, where in the money $200 calls and puts had their up and down ranges, so that we can monitor them, so that we will guide the entries accordingly. Just remember, MMTs, it would go like this. When you take a look at the $200 put here, it's $1.07 by $1.50, and the thing about it is that this is the back side of that trade of the 250 call. So we'll be monitoring. This price was $4.15 on the high. They're definitely wholesale. But let's take a look on a daily chart to see the relevancy. Here is a $200 put that will expire on a weekly level. And the weekly level is 9.2. So you have 5 days that are going to trade in Amazon. And here is the call side. This is a monthly expiration. Here, it's a 350, no, it's a 250 call now. So you're up and out of the money. And it expires 9/17, this one. And this one is a weekly $200 put. And the price of that is down to $1. So that's in the short term for the intraday trading. This is down at you take a look at the high of 415. It's down here now. So this, in the very shorter macro of a half a day or an hourly trading thing, is getting what we call short term deflated. That, depending on how the equity trades, is if we fail, we're going to be wanting to transact that. So once again, $200 put weekly that expires 9/2 with a 9/17 monthly 250 call up and out of the money. So there is the bid and ask right here on that put. There's that high, that chart that I just showed you. So short term, this thing is getting down to wholesale entries. Should Netflix fail, and this is going to be the end of it, we're going to want to know. Okay? And the part that we're going to guide by is knowing that if we fail here on that diamond, starting the last dog days in the last calendar month, and we start to descend in value, then we know that we'll be transacting the $200 put. Okay? And the standard daily, weekly chart that hedge fund managers and institutional people look at is the pink line is a 50-week moving average, and that weekly moving average is a bottom-up process in the weekly wick here. This is not your MMT platform, but you can see the pink line. That's how the public is going to react. And once again, the trading range on the weekly level was the low of 203.35, and the intraday high was 223.71, and Friday's closing bell looks like it was 221.89, and the total volume count, MMT, well, wasn't all that bad. It was 20 million shares. Okay? That's what this looks like on that level. So you know what that bottom up, that low to that high. Then it opened, though, at 212 during the week. It made its lows, and then it made higher highs from its original weekly open. And that is bullish to the upside, where if you consolidate at the higher level, then those contracts are going to pay in that trade. Now, there's going to have to be trade management. What happens is the public doesn't know how to get on this side of the market should this fail. This is where the money would print should it fail. And the thing about it is you got to be proactively weighted balance on your entries based on directional price movement, so that both sides of the marketplaces in NFLX, the 250 call in this case, and a $200 put as well, using a weekly against the monthly up and out of the money 250 call, and all the other strike prices for that matter. Once again, you've been given a gift. The gift is MMTs, is what side of the market do I get on?